Hey everybody, it's Darren and Trot.
Did you forget my name today?
No, I thought you were going to say your name, but
Nope.
we didn't talk about you saying your name, so I kind of took you by surprise on that.
Yeah.
But hey, it's good to have you, and it's good to have you on this episode of the Heartland Multifamily Show, the place
For all things multifamily.
for all things multifamily. And today we're going to have a discussion because we are in the process of a capital raise. Now, we're not going to talk specifically about the capital raise. We've got I think we've got another podcast somewhere where we talk about what we're doing and how we're doing it, just to take some folks behind the scenes. But as a result of the capital raise, we tend to run into three. I mean, we've at least kind of condensed it down to three multifamily personality types. So Trot has had a lot of experience with this too, and here's what we'll find. So I'll just ask you this question. Just because I think this apartment project or the apartment properties we own are great deals, awesome, does that mean that you think that?
No.
No. Just because you think an apartment project we own maybe it's not that great, maybe it's not that awesome, does that mean that I might think that?
Nope.
No.
Mm-mm.
And you get the point. What one person's great investment is another person's lousy investment, and vice versa. And that's kind of the way it goes. And it's really kind of the way with most anything, but especially with multifamily, because especially when it comes to raising capital, you find you really have three personality types, really three. And so let's talk about the three personality types. And it's reasonably important to talk about this because not only for you to know about it, but you may be an investor either now or someday at some point in time that you're going to be wanting to get involved in a multifamily property, either actively or passively. And you're going to have expectations. And I bet you're going to fit one of the three personality types that Trot and I run into, and it's good to know what your personality type is so you get involved in the
Correct deals.
right multifamily property. Okay? You know, it's the old story of you don't want to be working on something for years and have your symbolic ladder leaning against the wrong wall 5 years later and figure out you got the ladder leaning against the wrong wall. Right. So that's where we're at with this. So let's dive into this a little bit. Let's talk about those three multifamily personality types. Why don't you lead off with what you see as the first multifamily personality type in terms of the investors that we work with and that we run into?
The first multifamily investor type, and I actually would say, even outside of our deals that we work on, I'd say it's the most common, is the income-focused personality.
Yeah, I would say it's probably right.
Yeah.
Yeah, so talk a little bit about, and I'm sure people have an idea, but just explain a little bit on that income from the multifamily personality type. What's that person more or less focused on?
They want to pull money out of the property every month or quarter or year, whatever the timeline is, but they want to pull money out of the property and earn the income, like we do it quarterly, but
Mm-hmm.
a lot of people do it monthly.
Mm-hmm.
And they're not so much focused on the long-term growth of the property. It's mostly focused towards passive income for them.
Yeah, so they're really interested in that income. Here's like a couple of quick examples. One is the person that's maybe near retirement or at that retirement age where they're really focused on a monthly or quarterly income. So they want to substitute whatever income they had from job, career, business they owned, whatever it is, with income from property. Okay, so they're really focused on that income because it's substituting the income that they may have had coming in before, and they may want to, of course, keep that income going over a period of years. So there's that, and we see those folks mostly on a passive end of things. Another example, and this is maybe more on the active end of things, but still applies to passive, but more active, is, we've had clients and multifamily property owners over the years. Their attitude has basically been, look, as long as these properties give me X amount of dollars a month in income, I'm not really that concerned about how much they go up in value. I want $5,000 a month. As long as I get that $5,000 a month, I'm pretty happy. If they go up in value, fine. But it doesn't have to be the case. So that's an example, at least two examples, and you're right. Income is the most important thing for them when it comes to their decisions in investing in or buying that next multifamily property. And I would say, to your point of, it's probably the most frequent conversation we have, I would say, yeah, it probably is. And not by like landslide, so it's not like 70, 80%. I'd say it's probably closer to maybe 60%.
Probably, yeah.
I would say so. So yeah, so income. So that's multifamily personality type. Number one is income. Why don't you go ahead and rattle off the second one?
You then right after that, you find the personality type of growth.
Growth.
Growth. How much will my property appreciate, or how can I, take this 100 units and build that into 200 units and so on. And I think maybe more long-term thinking as well within the growth.
Yeah. So, yep, 100%. So those are investors that are more focused on, here's where our value is today. Let's just keep increasing that value as much as we can and as quickly as we can. And even if we have to sacrifice some income and some cash flow to do that, let's do it. So let me use a couple of examples of that. So, we have a 4-person board of advisors for one of our multifamily funds. And most of the conversation that we have with those board members is around growth. So these board members are more interested in going from point A to point B as much and as quickly as we can. So if that means that we have to sacrifice income to make improvements on the properties, for example, we're going to do that. If that means we have to sacrifice cash flow in order to maybe buy and add another asset, another property to what we own. So instead of making distributions, we put that money over here and then we use that money to buy something else. That's what we do. And so they don't really care that much about monthly or quarterly income. They're more interested in growing the empire. Okay. And then you look at the active side of things. So I think investors that own or invest in like properties like single family homes or condos, or invest in properties in markets where the pricing is just absolutely crazy and pretty much predicated on appreciation, that'd be the same thing. You're looking at owning that property, maybe hopefully breaking even or better every month, but as long as it continues to go up in value month after month, year after year, you're pretty happy camper. So yeah, that's the growth mindset. 100%. That's a growth mindset. And what do you think percentage-wise we see, Trot, from the growth multifamily personality type?
Probably a little bit lower, maybe 25%, I would say.
Yeah, 25%. I would say that's pretty accurate, yeah. So about 25% of our investors that we work with, actively or passively, are pretty much majority focused on majority growth focused, I guess is what I want to say and how I want to say that. Okay. All right, so we've covered two. We've covered income, personality type. We've covered growth, personality type. Okay, so you said the income is about 60%.
Yep.
Ish. You said growth is around, did you say 20%?
25 probably.
Okay, so now we're at 85%. No,
Yep.
So now we got about 15 to 20% left. Okay, what personality type makes up that 15 to 20%?
A mixture of both of the first
mix.
two. Yep.
The mix, which is another way of saying people that expect both.
Yep.
Investors that expect both income and growth, and they're expecting them to be, together, and that investment continues to, rise in value, rate of return, as a result of that. And so I would say that your 20 to 25% is pretty much spot on in terms of what folks are looking for in terms of not only growth, but also income. And when you look at that, again, a couple of examples, both passive and active, is if you're passive, you want to make sure that you're involved, and we're going to talk more about this. You're involved with people that have a balance of income and growth in mind as they manage the properties month after month, year after year. Okay. If you're active, you're out looking to buy 8-unit, 12-unit, 24-unit property, you're going to look for a property that is going to provide you the opportunity, at least in your mind, of balancing both of those in terms of income and in terms of growth. And so, yeah, those are the three. So we got income, we got growth, and then we got mixture of the two personality types. So here's a real cool thing that Trot and I have discovered. There's really no wrong answer here. There's no wrong answer, right?
Personally, for yourself personally, there's no wrong answer. But if your main focus is income, you don't want to get involved with an investor that manages the fund that their main focus is growth, because you guys are not going to see eye to eye on what to expect. So personally, no problem, no right, no wrong, doesn't really matter. But then when you go find the partnership or whatever, you want to be aligned with that. Somebody that's more focused on the income as well.
100%. Yeah, you're exactly right. And you said something very important there. You want to be aligned with them. Whether if you're active owner investor, you want to be, of course, aligned with yourself, and whether maybe it's you and a partner, maybe it's a, spouse, significant, whatever, you're buying this property, you better be aligned in terms of what you're going to be doing and how you're going to be doing it, whether it's income, whether it's growth, or whether it's a combination. You better be knowing that before you get involved in it, versus just going out and finding a 24-unit property to buy, and okay, well, now what do we do? Well, you need to be having those conversations
right
before you take over. And have the same conversations from a passive standpoint. I remember a couple of years ago, one of our funds, we decided to take a year and a half, pretty much, and take all of the income and just dump it into the properties. I mean, new common area, new flooring. We just made improvement after improvement, new parking lot, you name it. We just started making improvements because we saw that the market was going to have a significant uptick in value and appreciation in 2022 to 2024. So this is like about 2018, 2019 when we did this. And, we had a handful of people that weren't happy about that. They're saying, where's my check this month? Where's my check this quarter? Well, Frank, if you remember, what we talked about is oh, yeah, I forgot about that. And some people would be like, I still don't like that. And so, of course, we had to make some decisions and, parting ways as a result of us philosophically, having different ideas on where we're going and what we're doing. But the point is, and you hit the nail on the head, you need to be having these kinds of conversations, either worst case with yourself or with others that you plan on getting involved with, using your predominant multifamily personality type, and then making a decision to move forward with whatever you're considering doing, knowing that that's what you want to do and that's the direction that you want to go. It's not perfect, but it saves a lot of headache and a lot of problem later on if all of a sudden you're at a point where that you didn't or you weren't expecting to be, right?
Right.
Awesome. This has been really, really good. Trot, you got anything that you want to mention in closing of this episode?
No, I got nothing. Nothing left in the tank.
All right. Well, thanks for joining me. Thanks for helping me out and having the conversation of the three multifamily personality types. And we want to thank you for joining us on this episode of the Heartland Multifamily Show, the place
For all things multifamily.
for all things multifamily. Thank you, everybody. We'll see you later. Bye-bye. If you enjoyed this video and you want to make multifamily a bigger part of your investing world, make sure you click here on this video to discover the 3 easy ways to invest in and own your own multifamily property.